Well, folks, we are living in one of the strangest financial times we have certainly gone through in a long time at this point in time, folks. We've got to talk right off the top about margin debt. It has been absolutely collapsing. I want to take you through the numbers, multi-decade lows. We got a lot of stocks to talk about in this video. Tesla, Meta, Amazon, Apple, a lot of small cap stocks in this video to speak about. A lot of things going on in the market. We got some huge earnings coming on up actually this week that we got to speak about, and some opportunities there that I want to speak of, and a lot more things. I appreciate y'all joining me as always. Thank you for being here. Thank you for smashing the thumbs up button. I appreciate each and every one of you. And let's go. Let's just start getting through this, guys. Appreciate you being here. Alrighty, so where I want to start today's video is something we haven't spoke about on the channel in quite some time, which is margin debt. Okay, so what we're looking at here is this is margin debt as a percent of the S&P 500. Now, it's important to always look at as a percent of the S&P 500 because obviously the numbers get a lot bigger as time goes on. The market in general is a lot bigger, so naturally the margin debt's going to get a lot bigger as a total number, right? Think about where the stock market was valued 70 years ago versus today, right? Think about how much margin debt would have been out there 70 years ago versus today. It's going to be completely different numbers. So as a percent is what you actually want to look at. Here's the deal. Okay, right now we're basically trading back to where we were in about 2002, 2003. So about 20, if not a little over 20 years ago. So multi-decades we're talking about. Now, what's interesting is the last time we were down at these sorts of levels, guess what happened? Well, we had just bottomed out the stock market from the tech bubble, which is extraordinary because if you think about the market we've gone through, right? A lot of people looked at especially 2021 as being kind of like the tech bubble highs, right? Where you had all the Cathie Wood stocks flying and just everything was flying. Bitcoin, crypto, like everything was to the moon at that point in time, right? And obviously it's been, let's call it the downward cycle of that time period for really the past 2 to 2.5 years at this point in time, which the tech bubble took 2 to 3 years to bottom out everything in regards to that. Certain things bottomed before other things, certain things took a longer period of time, but it's very intriguing that we are back to those sorts of levels that we were when the tech bubble basically was coming to a conclusion and an end at that point in time. Extraordinary, right? Now, if we want to take this a step further, look at the Wilshire 5000, okay? This just kind of looks at the 5,000 biggest stocks in general for the market, right? Check this out. This is where we were at in the tech bubble top of like 99 going into 2000, which is literally right when the bubble popped essentially, okay? Then we had to come down to that over several years, and for the Wilshire 5000 as a percent, we bottomed that baby out right around kind of like 2002, right? Look at the level we're at right now. It is literally as a percent margin debt, as a percent of Wilshire 5000, it's literally right about the same as when we bottomed out from the tech bubble back around 2002. That's extraordinary to think about, folks. That's interesting. I think that's one of those things you shouldn't just like not pay attention to. I think it's very important to pay attention to that, okay? And if you're feeling a little, let's call it bullish on the market over the coming years, that should definitely be something that you're a little excited about there, okay? Look at where we were going into the great financial crisis, okay? I mean, obviously, margin debt as a percent of the Wilshire 5000 has shot up in a epic way going into the great financial crisis, right? And then obviously 08, 09, the great financial crisis hit huge, the economy sank and things like that. And obviously we came down from those levels, but we didn't come down as extreme as you might think. And that's really because we went into a 0% error where margin debt was very cheap during this time period because the Fed funds rate was pretty much at zero for all of these years here. Plus a lot of people viewed it as it's a new cycle forming, a new cycle of employment, of housing, of everything in general. So yeah, but extraordinary to kind of look at where we were at versus where we're at now. Multi-decade lows on margin debt. That's something I look at, and that makes me feel very comfortable, folks. Very comfortable buying up this market over this next 6 to 12 months. I feel very comfortable buying this market over the next 6 to 12 months. I love seeing margin debt as a percent of the S&P 500 and Wilshire 5000 at multi-decade lows. For me, I love that, folks, okay? I don't want to see those numbers super high. When I see those numbers super high, I get a little worried. I get a little worried about what's coming, okay? When I see those numbers very low, Oh, that makes me very excited over the next 5 to 10 years, right? It makes me very comfortable being a buyer of the market over the next 6 to 12 months, right? Oman posted this inside the private group today. I love this. It just said, risk is high when investors feel the risk is low, says Howard Marks. And that's just so well put. And if we kind of look at the market in general, right? I mean, every time you really had margin debt spike up in a massive way, it was actually when you should have been very, very worried. Now we're at a time point, think about it, '02. Right? 2002, you'd just gone through the tech bubble. A lot of people were so bearish on stocks. They'd been bitten, obviously, by the tech bubble, and they were so negative on the markets. Plus, we had a very dramatic event happen in the United States of America in 2001, arguably the most dramatic negative event we had in the last, probably since, the 1940s, right? Horrible day in 2001, toward the end of 2001. So you had that. You had the tech bubble come down. And so 2002, a lot of people were they didn't feel very good about the stock market. They didn't feel good about financial markets, right? Which is very similar to what we have going on now. It's a different set of reasons. It's a different set of reasons, okay? But it's always a different set of reasons. Check this out. I went to Fidelity to see what their margin rates are right now. This is brutal, okay? This is another huge reason, not just comfort levels of the market, but margin interest rates. Look at this. If you have over $1 million in Fidelity investments right now, folks, the margin interest rate you're paying is 9.25%. That's if you have over $1 million. That's brutal. And so this is what most people have between, let's say, $25,000 and about $500,000 in their stock market portfolio, right? Look at, you're paying 12 to 13% right now. It's not even possible. Margin's always a dangerous thing. But if you're paying anything over an 8% rate, it's super dangerous because usually the saying is you can get about 8% a year in the stock market, right? Well, if you're having to pay 13, 12%, it's you can't even consider it, right? So even the highest net worth individuals cannot consider margining in this market right now. It's literally ludicrous right now, right? That's what we have going on. Here's the math behind this. Fidelity did a great example of this. Let's say you have an average daily debit balance of about $100,000, right? Times that out by the margin interest rate there. You have $33 of margin interest a day, and the next day, and the next day. It's $33 every day. I mean, the average worker in the United States of America makes, $200 or so a day? And that's before taxes and all the other crap, okay? So you can basically just say $33 of that's going to margin. You can't even conceive of this, folks, okay? So that's what we have going on right now. At some point in time, margin will come back. It will come back when the market feels comfortable again, when investors feel comfortable again, and when margin rates aren't 12, 13 plus percent, okay? I don't know when that is. It might be years from now. It will be a gradual process of kind of like margining getting higher and higher, but we're a ways away from that. And then I don't think we'll have to worry about margin being a problem in the financial markets, in the stock market, for probably 5+ years. It'll probably be 5 to 10 years, and then we'll have another cycle where we'll have to worry about margin again, becoming a big percent of the Wilshire 5000 or the S&P 500 in general. But we got smooth sailing for a while in regards to the margin story, and that is just one of many reasons I feel extremely comfortable being a big buyer of this market over this next, let's just call it, bit of time. Which, by the way, just want to shout out, if anybody needs a job watching this, which there's probably not, I think all you guys have jobs, you have your own businesses that watch my channel, but if there's anybody that needs a job, okay, Fontainebleau, 6,500 people they're hiring, and then Durango needs another 1,000 plus. That's another new resort that's opening. So a lot of jobs here in Vegas, baby, okay? David Tepper, which the Carolina Panther fans know is probably an owner you don't like too much. David Tepper just doubled down on Meta. Now, David Tepper, he might not be the best at running a football team, but I can tell you David Tepper has been an incredible investor over time with some incredible returns he's gotten over time. And now he's brought his portfolio total up to about 8%-ish, it looks like, of Meta stock overall. Now, here's what I'll say about Meta stock, right? You asked me, is Meta stock a buy, a hold, or a sell right now? The stock's had a tremendous past year. Pull up a 1 year of Meta stock, pull up a year to date of Meta stock, pull up a 6 month of Meta stock. It's been tremendous, right? But you can ask me, is the stock a buy, hold, or sell right now? Okay, here's what I'll say. For me personally, it's a hold. And the reason being is I have $547,000 out of about a $1.7 million public account, right? Which is available for everybody in the private stock group to see every single move I've ever made in that portfolio. So that's a huge, heavy position for me. For me personally, it's a hold. But I got to say, in general, Meta's a screaming buy still, even after the extraordinary move up here. It's a screaming buy. The stock's trading at 22 times this year's numbers, about 18 times next year's numbers. What? For a company with this sort of business opportunity in this sort of market? Are you kidding me? Here's the deal. Next year, they're expected to grow revenues by about $16 billion, folks. $16 billion. So Meta's a steal deal. If we look over time, Meta's traditionally been a company that's phenomenal with beating earnings quarter in and quarter out, and that's why it was a great stock, right? It bottomed out after the IPO at about $18, $19, and then it went on a run to $350 plus over the next 10 years or so. And the reason it did that, or actually less than 10 years, the reason it did that is because it was a great company that just, you knew they were going to be numbers quarter in and quarter out. And then they went through, obviously, their really tough time at 2022, where they missed 4 out of 5 quarters in a row. And that's why that stock went from, nearly $400 to $88. You can't just keep missing and missing, right? Now, here's the deal. They beat their last 2 quarters, and I think their biggest beats are coming up. I think this is going to be a company that beats numbers quarter in, quarter out for many quarters to go in the future. And so that's going to be very bright days for Meta. And keep in mind, there's also something huge coming up for Meta here, which is about to be their grand AI presentation type event, where they're going to show off a tremendous amount of things. And so that's very exciting as well. So that's kind of more of a short-term, I guess you can say, bullish catalyst. But over this next year, at least, Meta has so much going for them. It's not even funny. And obviously, long-term is brilliant there as well. Tesla got a sell rating slapped on it today by Guggenheim on negative demand indicators. Tesla on Monday, basically Guggenheim put a sell rating on the stock. The firm sees supply-driven delivery declines in Europe and China for the third quarter compared to the second, and noted the negative demand indicators remain an issue with lower realized prices. Guggenheim sees third quarter deliveries of 445,000 versus a consensus of about 461,000 and 466,000 in the same quarter, same last quarter. Okay, so previous quarters on a sequential basis. The firm sees an average selling price of $44,350 compared to consensus, which is just about $150 above that. Okay. So, once again, is this any new news? No, we know demand for Tesla's not great right now. We don't know, is Tesla going to come in at 445, 440, 450, 455, 460? Does it matter for the long term? The answer to that is absolutely not. It's completely irrelevant. The long-term story with Tesla is intact. And you know what I thought was very interesting today in regards to Tesla? Did you see the stock price of Tesla? I thought that was very intriguing here today. I took a peek at this, right? I saw the sell rating, and I want to say, what did Tesla do today? It was green. We were up about $3,500 on the Tesla shares in the public account here today, which I thought was very intriguing. That it seems like investors are just kind of like bored of the whole demand's not going to quite hit. At the end of the day, I think most people that are in Tesla stock are really thinking about this over the next several years. They wouldn't pay the type of forward P the stock has on it unless you really believed in this over the next several years, right? We got another thing to talk about in regards to Tesla a little later on in this video. But yeah, folks, seems like Tesla's investors are moving past this whole, are they going to hit 445 or 450 or 455? People are they're bored of that whole story there, okay? iPhone 15 lead times extend to record highs, Morgan Stanley says. Investment firm Morgan Stanley said on Monday that lead times for the iPhone 15 have hit record highs across North America as of Friday, which the firm said is encouraging given the somewhat tepid response to the unveiling, 100%. This gentleman, this analyst, has an overweight rating, a $215 price target on the stock, right? He said that the next 2 weeks will be critical to determine the cycle for iPhone builds and revenue for the coming quarter, but that he is encouraged. Quote, looking at past cycles, new model iPhone lead times generally extend in the first week after pre-orders begin before starting to level off, basically, the analyst says. Therefore, it will be critical to observe how iPhone 15 lead times trend this week and into early October when iPhone 15 Pro Max supply improves and Apple adjusts its build forecast based upon early pre-orders. A couple of things here, okay? First thing we got to talk about is this bullish for Apple or is it bullish for the economy? Let's assume that iPhone 15 is actually selling like insane, okay? Let's say there's crazy demand. Is that bullish for Apple or bullish for the economy? I might lean a little more toward the economy than Apple just for the mere fact that I literally, I talked to so many people about this iPhone 15 just to see if they were excited, if they're going to get it. And I can't find people that are excited, okay? Other than I asked people in the comment section, a few people in the comment section said they were going to get it. But outside of that, in like real life, I've just been asking people. Like, it doesn't seem like this is an exciting new iPhone at all. So if the demand's really like that, then I don't know, maybe it's a little more bullish for the economy overall. Now, something else I wonder is Apple started this upgrade program a few years ago, and I bet you they've probably built a lot of customer base off this. And these people, they almost kind of get a little bit of like first dibs on the iPhone. So I do wonder how much of a factor this has, because 10 years ago, this wasn't like a thing, right? Nowadays, it is a big thing that people basically pay this monthly fee and then they get every single new iPhone that gets out, right? And so that almost puts like a huge demand pool for basically every single iPhone that comes out in the market, right? So that's something I was thinking about. Another factor I was thinking about that is really big is if you own any chip suppliers to Apple, man, if demand really is that good, I can tell you this is great for companies like Skyworks Solutions that has several chips in the iPhones, right? Great news for Cirrus Logic, Cruisy Doozy, or many other folks that are big chip companies in the iPhone. So yeah, we'll see where it all shakes out. I don't want to get too excited over this whole iPhone demand thing that we're talking about right now. I don't know. You know, I even heard there was a fire at one of Apple's big India facilities because they're starting to produce these iPhones out of India as well and in China. And so I heard that's hurting supply in the short term a little bit. So I don't know, man. All I know is I don't want to draw too big of conclusions from any of this. We'll see where demand really is come the springtime. I think that's when you really get to factor in what demand's really like for the iPhone or not in the springtime, right? Because you're always going to have that initial, celebrities, all those type of people like, influencers, they all have to buy the newest iPhone every year no matter what. You have the upgrade cycle no matter what, right? So that's always like a guaranteed amount of folks out there. High-end business professionals always going to pretty much buy the newest iPhone, don't matter what. And then after that, you kind of ask yourself, okay, what about moving forward? How's demand looking? You start to get a little clarity of that in the winter quarter, but you get a lot more clarity from that, certainly in the spring quarter. So we'll see. I don't think it's time to get too excited. Speaking about not too excited, the analyst community downgrading Foot Locker here today. Jeffrey moves to the rating sideline. Jeffrey lowered its rating on Foot Locker to hold from buy on broad concerns that the retailer will be negatively impacted by a slowdown in consumer spending. Analyst Corey and the team noted that Foot Locker has witnessed 2 consecutive months of negative foot traffic, with 3 of the last 4 months seeing negative year-over-year declines in spending per trip, according to recent data reports they're saying, right? My response to that would be, you come out with this now, the stock's down 52% this year. 52% on an up year for the S&P 500, double digits, and probably, it might be 10% or so for the S&P 500 this year, 10 or 11%. Obviously a great year for the NASDAQ. This stock's down nearly 53%. It's been overcut in half this year, okay? Yeah, I think everything's been priced in for Foot Locker, okay, outside of like end of the world. Like this stock's had everything thrown in it. Yeah, even if you get bad news, I don't even think it's going to affect the stock much anymore moving forward at this point in time. I think, when this baby bottomed out, it was $14 and change. That was what it was. And that was kind of, throw the kitchen sink at it, worst case everything. And so even if Foot Locker numbers are not the best over the next couple quarters, which I'm not expecting that certainly, I think the stock could actually move up, believe it or not, which is counterintuitive. But remember, these stocks go down significantly more way before anybody realizes why they went down, and they go up way before anybody really realizes why they should be going up. No, they added insult to injury here. Nike just got its bull rating taken down by Jefferies, also due to concerns over consumer slowdown. Jefferies downgraded Nike to a hold rating from a buy on Monday. And this is, the company's going to report earnings this week, which we'll talk about. That's a very important company reporting earnings this week, and a few others as well. The analyst, different one here, Randall, and the team sees incremental risk for Nike as the wholesale channel is likely to remain pressured and growth in China faces macro headwinds. Meanwhile, our consumer survey results indicate that U.S. consumers are likely to reduce spending ahead, with apparel and footwear being the most likely areas to see pullback, he says, right? And this is another one of those where I say, dude, the stock hasn't gone anywhere for 5 years. And this is Nike. This is one of the best companies, certainly in the stock market, right? And in the world. And so I just think these pylons of moving to sell ratings or hold ratings, I just think it's way late to the game. Way late to the game at this point in time. I think if anything, you need to be putting buys on Foot Locker and Nike and stocks like that for this next, several months essentially, because these stocks have been destroyed over this past couple of years. And, the stock price will bottom way before the bad news bottoms for these stocks. And that's something you got to always be ahead of Wall Street when it comes to all these sorts of things, right? The studios writer strike is basically coming to a close, right? The Writers Guild of America in Hollywood studios reached a tentative agreement Sunday night that sets the stage for the end of a strike that's been going on since May. That's definitely good news for Netflix, for Disney, for all the others, that this is chapter is finally closing, and honestly good news for LA in general, because I can tell you there's a lot of folks that are employed in just different roles that aren't like a famous actor or actress, let's just put it that way. So yeah, something going on there. Okay, this is just a random thing I saw while I was actually preparing this video. Evergrande, China, Ariana Evergrande, did you know this is still a public company? How is this even still in the public markets? Their stock was down 22% today. And these other Chinese real estate companies, Country Garden and this Logan Group, they were all down a bunch today. I'm like, how are those companies even still on the public exchanges? That's just mind-blowing to me, absolutely mind-blowing to me, right? Cybertruck units show impeccable build quality. Very exciting times with Tesla, obviously, in regards to Cybertruck. We're not going to see it in the numbers, certainly, over this next few months, but you will see it in the numbers in 2024 in a significant way. And just a real bright spot. I can't wait to start seeing some of these on the road. It's such a divisive vehicle. Some people just think it's the ugliest vehicle in the creation of mankind. Other people absolutely love it. They can't wait to get their hands on it. Let me know in the comment section, by the way. Do you love Cybertruck's design? Do you hate it? Are you in the middle? Because I haven't really found anybody that's in the middle when it comes to Cybertruck design. It seems like people either love it and they would love to get one of these. It's like their wish list of one of their favorite vehicles to get if they could get it, right? And then other people just think it's the ugliest thing ever. So let me know in the comment section. I'd love to hear from you guys. I'm always intrigued with that, right? Elon Musk says Tesla has a performance Cybertruck. This is intriguing, right? So we're going to see what happens here. But yeah, believe me, Cybertruck excitement will be in full effect in 2024 around Tesla and Tesla stock, okay? It'll be in full effect. And so, this hasn't really been the year people are excited about Cybertruck, obviously with interest rates being so high, and then obviously Tesla's just getting some units out there. But yeah, 2024 is going to be a very exciting time for Tesla in regards to Cybertruck. Now, this week we have a lot of very important earnings, folks. Actually, 4 super important earnings. Now, we're technically not in earnings season right now. Earnings season is technically over, and the next earnings season starts around mid to late October. But you kind of have these straggler companies report at just awkward times. And we got 4 important ones this week. Costco's reporting. I want to hear from Costco any weakness in spending. Costco is one of those companies you usually don't hear about any weakness in spending because Costco just puts up their numbers quarter in and quarter out. If we hear any weakness in consumer spending coming out of Costco's mouth, that would definitely be a telltale sign that recession's coming in 2024. Fed lags are catching up, and you'll see some consumer weakness, right? So I think everybody should pay attention to what Costco says. You can read their earnings transcript they'll have, or you can listen to their earnings call on Tuesday night. I think that's going to be an important one, folks. Important one. Micron. We want to hear from Micron. Micron is one of the biggest memory chip companies in the world. One is, are we seeing kind of a bottoming of a lot of these electronic-related products that have been just not in a good place for a while? And also, we know there's going to be a lot of memory needed for AI-related chips. Are they starting to see any uptick, and how substantial of an uptick are they starting to see, and how big is this going to be for Micron overall? I think there's going to be a lot of questions in regards to that on their conference call. Nike reports on Thursday, right? I think when it comes to Nike, we're really trying to figure out when the business is going to bottom. Because if, let's say we feel like the business is likely bottoming like Q1, Q2, the stock will be bottoming basically now and over this next few months. Because remember, the stock's going to bottom way before the business bottoms. Everybody wishes the business bottoms here, that means the stock bottoms and it goes up. No, it plays 6 months, 9 months, 12 months in advance. And so I wouldn't be surprised if Nike's kind of in a bottoming phase here. And I wouldn't be surprised if it starts to move up even in Q4 and into Q1. Okay. Carnival Cruise Line, looking to hear from them basically any info on if they're starting to see a travel slowdown, because we know the cruise operators have been full go, and business has been tremendous for the cruise operators. Do we have any sort of slowdown? Are we hearing about any sort of slowdown in travel demand? The good news for Carnival is they compete very on the low end. Like, I don't know if you guys ever priced out like a Carnival cruise. It is not expensive, especially if you're going on just like one of those 3-day, 4-day, 5-day type Carnival cruises. Of vacations you could take, it's one of the cheapest you could possibly imagine. Here's the deal, okay? A Carnival cruise for 2 people, unless it's something crazy, might be like $1,000, maybe $1,500. All your food's included. There's a little upcharge if you want to have like unlimited drinks included, as in like, let's call it type drinks, okay? And you don't have to pay a flight, obviously, unless you're flying to a location to do a cruise, but most people just drive there and then get on the cruise ship, right? So there's no, $600, $1,000 plane tickets, so you don't have to worry about that. All the food's included, right? I mean, just trust me, like, of vacations you can take, cruises are usually one of the most, especially Carnival cruises, one of the most economically viable ones you can take. So if there's any trade down of people saying, I don't have $8,000 to spend on a vacation like I did a year ago, so instead I still want to take my vacation, but instead I got $1,000 or $2,000 to spend, there you go, there's your cruise line. So this should actually be a really intriguing one, okay? Now, I was looking at stocks today and a lot of things going on in the market today, and there's a few things that caught my eye. One was, of the stocks I own, Fubo was the best performing stock here today, with Qualcomm being the second best. But, when it comes to Fubo, Google Trends data is still looking phenomenal. This is the past 5 years for Google Trends data. And we should see a little bit of slowdown in Google Trends data for the next couple months here, but we got a lot of big things coming for new spikes of Google Trends data. F1 race in November in Vegas, I think is going to be huge. I think that's going to be probably the most watched F1 race by far and away in the United States history for F1 races. It's going to be insane. So I wouldn't be surprised if I see a big Google Trends move for that race. Bowl games, and then you have the playoffs, NFL playoffs, starting in January, so that's going to be huge for Fubo. You have the Super Bowl in February, that's huge for Fubo, obviously, and then the Olympics in summer 2024, which is going to be huge for Fubo as well. So that's when you'll see the next major spikes in terms of Google Trends data for Fubo. So really exciting, next bit of time here for Fubo in terms of attracting a massive amount of subscribers. CMG, which is a stock I'm hedged against, right? It's interesting. I saw the stock was down again today. And this is when all the indexes were green. Dow was green today. S&P was green. NASDAQ was green. And Chipotle was down here today. It was down almost 1%. It's down about 8.5% in the past 3 months. And this is a hedge for me because I just looked at it and I was trying to get ahead of Wall Street. I'm thinking, okay, high valuation name. If comp store restaurant sales that have been coming in insane for Chipotle's weaken in any way, the stock's going to get crushed like a souffle. And it seems like there's a little worry starting to build in Chipotle, and I might have gotten in front of them here. We'll see. But their numbers have to come in where their comp store restaurant sales are kind of much weaker than they've been. If they come in much weaker, the stock's going to get crushed like a dang souffle, okay, as Elon would put it. And we'll see. We'll see what happens there, but it seems like all of a sudden Wall Street's starting to realize kind of the risk in regards to stock over this next, I don't think long-term Chipotle is a risky company. I just think for this next 6 to 9 months, it's a very risky company, okay? Now, Oracle fell again today, folks. Oracle keeps falling. It's down about 15% since earnings. I'm getting really intrigued with Oracle. I don't own any shares yet, but I'm telling you, there's a high probability I could buy it. I've done a lot of research in the company over the past week and a half to 2 weeks, and I'm pretty excited. The balance sheet's trash. Outside of that, everything else is pretty dang good with the company. And so, I don't know, man. At some point in time, I'm going to have to probably pull the trigger on Oracle, and it's coming sooner probably rather than later. But the problem is there's so many stocks to buy right now. That's the other problem. No. Once again, Dow was green today. S&P 500 was green. NASDAQ was green. It wasn't like it was some crazy green day, but it was a green day. But look at these consumer-related stocks. They just continue to fall. Estee Lauder, one of the most well-run companies of the stock market the past 20 years or so, fell again today, down to 145. Dutch Bros down again. Bros can't catch a break right now, right? Even on a green day, still down another 1% plus. Winning Resorts is at, the market cap's back to where it was in 2010. It makes no sense in regards to Wynn Resorts, but that one continues to get hit. Target continues to get hit day after day after day. This one touched, I think it was $109 today, $109, $110. Crazy, man. Nike fell again today. Bath & Body Works fell again today. Cheesecake Factory fell again today. These consumer-related stocks, they're all pricing in recession. These stocks are basically telling you recession will hit in 2024. That's as simple as I can put it. That's as simple as I can put it. Either Wall Street's wrong or the market's wrong, or it's right as it almost always is. It ends up being right? And it doesn't make sense when you're in this scenario. So, people look at Wynn right now and they're like, why is the stock falling? And even myself, I'm like, the business is great. They think business is going to weaken considerably for them in 2024, and they're trying to get ahead of that, right? And then when the business is weak, that's when the stock will start popping up again. It's just, that's a stock market for you. So weird times, man. Housing stocks continue to get hit. Rocket down again today. The stock's down $8 and change now. Tricon Residential. Does somebody know something in regards to that one? Like, did they get over leveraged? That's what I'm starting to wonder in regards to Tricon, because that stock is just very, very weak. Boston Properties, kind of more of a commercial player. They fell again. D.R. Horton fell. CCS, Century Communities. Home Builder fell. Lennar fell. Toll Brothers was down here today. Those housing stocks are trying to tell us something as well, I think. Okay, FinTech, man. I was curious what would happen with Square today, and the stock finally bounced. Which is some good news for Square stock. Unfortunately, SoFi and Hood, they can't get out of the hood, man. Those stocks are stuck there right now, and they just can't get out, man. SoFi down again today. Robinhood down again. And once again, even for green indexes, those ones just can't catch a break right now. I like what I saw from commodities today with all three of the major indexes green. I liked seeing oil down today. I like seeing GSG, which you can just add GSG to your watch list so you have an easy way to track commodities. GSG was down here again today. We need to see inflation continue to come down. In order to continue to see inflation come down, we need these commodities to be in a weaker place over this next, let's just call it 6 months. And then if these commodities can do what we need them to do over this next 6 months, inflation won't even be a story moving forward. I think it's becoming less and less of a story at this point in time, right? Obviously, CPI is in the 3s now. It's just not as big of a story as when it was in the 7s and 8s and all the other crazy numbers. So it's becoming less of a story. I think more and more folks are worried about the consumer, or worried about recession in 2024 and some of those sorts of things. But we need to kill off inflation. Once we kill off inflation, then we can talk about where we're going from here. But we need to just bury this thing, man. So commodities, please just chill for this next 6 months, and let's just kill off inflation once and for all, okay? Now, in terms of market, folks, okay, I did a whole video inside the private stock group earlier today, and it went through the ridiculous amount of stocks right now that are at multi-year lows or multi-decade lows. I was able to do so many companies, and these were all like famous companies too, like everybody would know these companies. I was able to do so many companies that I started to fall asleep last night prepping this video, because I'm like, this is too many freaking companies. Like, this is ridiculous. The amount of companies at 3-year lows, 5-year lows, 7-year lows, 10-year lows, 20-year lows. And I'm talking, these are famous stocks, not some like company, I never heard of this before. Is this some new IPO or something? No. These have been companies that are been around a long time, like decade or decades. These companies have been around. And it's extraordinary. It's almost like the stock market is basically going through its own crash right now that no one really sees, because the headline numbers have been holding up, because the biggest of the big companies, Apple, Microsoft, Meta, Amazon, those kind of companies have been holding up very well. But you go beneath the surface and it's crazy, folks. It's crazy. The market is starting to get really easy now. I will say that. And I mean really easy. An easy market is a market where you can look out there and it's just like shooting fish in a barrel, and there's deals all over the place. We certainly saw that with growth stocks in 2022, right? You rewind time to this time last year, it was an extremely easy market from if you were buying growth stocks, AMDs, NVIDIAs, Metas, any of those guys, right? Tesla, you could go through the whole list. Very easy. But now I feel like it's just an easy market in general, folks. I mean, we got deals, steal deals all over this market. And yeah, it's quite a time you got to take advantage of these sorts of markets, because I can tell you, it's not usually like this. Many times the market is very difficult. It's a hard market, right? And the hardest markets for me personally, as somebody who's been investing in the markets for, 15 years or whatever, right? The hardest markets for me is when everything seems very overpriced. Almost all the stocks are at multi-year highs, multi-decade highs, all-time highs. For me, that's a hard market, because I'm kind of looking out there. I'm like, dang, where are the deals at, man? Where are the deals at? And then if things are pretty good, you kind of like, how much do you want to hedge during that market? That's a hard market. This is not a hard market, folks. When you give me the type of quality companies you're giving me at multi-year lows and multi-decade lows, that's not a hard market anymore. I was out there buying today. I'm gonna buy every single week for a while, folks. This is an easy market. to take advantage of deals, okay? And I think it's going to remain an easy market for a while now there. So make sure you're taking advantage of deals out there, folks, okay? I got a couple of free workshops for you guys. Those would be pinned comment down there. One is investing foundations. This is more of a workshop. If you're in your first 3 years of investing, this will help you out tremendously. It's absolutely free to access it. Day 1 goes over why invest in individual stocks. Day 2, what to look for when researching a company. Day 3, portfolio management and managing cash. Day 4 is growth, value, and dividend stocks portion. Day 5 is how I know when to buy and sell stocks. And then the other workshop I'll also have down there as pinned comment is how I find 10x workshops. That's about a 30-minute video there, whereas the other one's about a five-day kind of video schedule there. So appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Make sure you get access to those free workshops down there. Those are pinned comment. I'm taking advantage of deals. I'm going to continue to take advantage of deals and own the world, folks. Much love and have a great day.